You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. If we sound a little bit different, then yes, we're not coming to you from our studio in Chicago today. We're actually coming to you live to tape anyway, from the FIA Boca Conference. You can hear the dismantling of the conference going on around us. It never fails whenever I start talking that the dismantling begins. And maybe that's a sign for me, I don't know. I am joined here by two old friends of the network. We have Derek Sammann. He is the Global Head of Commodities and Options Products over there at CME Group, as well as Blu Putnam. He is the Chief Economist over there at CME Group. Gentlemen, welcome back to the Options Insider Radio program.
Thanks, Mark. Glad to be here.
Let's start off. You guys just came off a very interesting information exchange. First off, I like to see options being made front and center at the Futures Industry Association. I know it's not in the name, but I'd like to see options sneaking in there every now and then. So, and actually pretty robust turnout as well. So clearly I'm not the only one here who likes to talk options when I come down here. But that said, Derek, we'll start with you, as we are wont to do whenever we have you on the network. You usually come armed with some interesting data. And as it works out, February was a slightly interesting month, as it turned out from an options perspective. I know you've had a lot of interesting records and trends and volume surprises over there at CME Group from an options perspective. So why don't you walk us through some of the ones that really resonated with you?
Yeah, it's been certainly a volatile time. And when you talk about volatility, you have to think about options. We've been in this really strange, hysterically low volatility environment for 3, 4, 5 years with the world awash in cash and just a real tolerance for risk, apparently. So what we've actually seen is that as we've seen volatility spike, particularly in the equities markets in latter part of January, and that's the volatility's carried through, what we've actually seen is significant growth and participation in our options business. If you actually look at the business that we did up through 2017, it was a record year. We did 3.5, 3.6 million contracts a day. Year to date in 2018, and this is data through about the 12th of March, 5.1 million contracts a day in the first basically 2.5 months of 2018. February alone, 6.1 million contracts a day in options, Mark. That is an unbelievable number.
People might think when you say that, you think total all products.
8 years ago, that would have been bigger than the total exchange volume. So it's unbelievable to see the growth and the increased participation across our options markets. And the story we've got is unique, that it can't be replicated anywhere else. We are the single largest multi-asset class exchange on the planet. So as you're seeing moves in WTI in the energy markets, as you're seeing moves in the equity markets, you're seeing moves in fixed income or driving in FX, this is the only place where you can actually access one clearing firm, one clearinghouse, one exchange to trade all your investable asset classes. So been a great story, and I would say the robustness of the platform, and really what has shined in this environment has been the electronic trading of our markets across the globe in highly volatile markets.
You know, one of the things that caught my eye, Derek, which is kind of interesting, and kind of a story that's kind of unique to you guys, we don't hear this a lot from other players, was one of the records you guys sent was strong volume yet again in the end-of-month contracts. It seems like those continue to resonate out there in the E-mini S&P and others. And again, that's kind of a story that's kind of unique to you guys. I'm curious, why have you heard of a lot from clients feeding back to you saying, hey, we really like this, something that lines up with the calendar month like this? What do you think is driving the growth story in that particular category?
It's part of our overall product development portfolio approach in that, in asset classes where we know customers are trading in complementary liquidity pools and where they're seeking the best opportunity to offset risk, we've actually, in speaking to our clients, been told, listen, it would make my life easier, or I could connect liquidity pools more effectively if, for example, you had options expirations that lined up with either cash markets or other SEC regulated markets, and I'm trading against those markets. And frankly, that's kind of the genesis of our weekly options in our S&P on the listed derivatives side. Weekly Fridays, weekly Wednesdays, weekly Mondays, because those line up with some of the expirations on the cash side. So, in some cases, we're talking to customers and saying, what parts of the portfolio are missing and how can we line up better with your overall portfolio of risk? In other cases, we've taken similar customer feedback and asked, what part of the curve are you most exposed on, and how could we build product that helps you manage that risk? In some cases, that's month end, in some cases it's weekly. In other cases, it's other products we've rolled out across different parts of the curve. And going back 5 or 6 years ago, it was the mid-curve options, where there was just no volatility in the front eight. So these mid-curve options gave you a short-dated product on the middle part of that euro-dollar curve. So it's about listening to your client and find out what's their unhedgeable risk. Can we provide a solution? Or if there's a suboptimal access to liquidity, how can we enhance that and give them an opportunity to spread that against other points on our curve? So it's a story of listening to the clients, Mark, and rolling out products that really connect with the parts on the curve that they feel that they're not quite deeply accessing liquidity on other venues.
And Blu, this is the first time I've had a chance to chat with you since the tumult of, shall we say, of the last month and a half. I know from an economist perspective, it must have been just a fantastic period. A lot of data points to study out there. I had a chance to catch up with your colleague Eric Norland on our TWIFO show a few weeks ago and kind of pick his brain about that. But I'm curious for you. I know for you, volatility and the systemic drivers of volatility are a big research area for you. So I'm curious. Let's start off. What are some of your maybe main takeaways from the market return, shall we say aggressive return of volatility over the last month and a half? And then what are you seeing as some of the interesting drivers therein?
Yeah, the drivers, particularly with the equity correction that we had back in February, were very interesting. The equities went down. They bounced back up. They tested their 200-day moving average, bounced off that twice, and then, came back. But interestingly enough, it was where the flight to quality was. You didn't go to bonds, because bonds were actually part of the problem. And that's because at the time, we were, that's when we heard about the government extension was spending more money, so huge more supply coming in. The Fed's talking about shrinking its balance sheet. So you get this source of volatility from a couple of different directions. You got the tax cut, which is great for equities. You celebrated that in early January, and then you say, wow, I got a lot of bond supply, and I might have more inflation. So you've got a lot of different forces coming together to create this volatility.
And, it's interesting, we've had a lot of, data points talking. I just came from a big event last week where, there was a volatility-themed event. And going into that, everyone had planned to talk about, shall we say, persisting in a low volatility regime. And now, all of a sudden, we're seeing that demonstrably changing pretty aggressively. Have you noticed any interesting, inflection points? The skew. I know skew is always a big study area for you guys, as well as just in general, some of the other interesting drivers. Not just in S&P. I know you watch the ags. You very much like to watch the weather charts out there. We talk a lot of energy out there. So any other interesting, drivers of volatility across the broad suite of products, not just in the indices?
Well, the big inflection points that are going to probably coming up in 2018. Obviously, the Fed rate decisions are one, is how far they go. But also, all of these trade negotiations hit a lot of different product. You take NAFTA, the U.S. exports a lot of corn to Mexico. They export a lot of natural gas to Mexico, a lot of cattle to Mexico. These are all important markets, and they're linked through NAFTA, not to mention, of course, the Mexican peso and the Canadian dollar. So, you pick up a lot of markets by one set of decisions. And, like those negotiations aren't going well. So the U.S., I think it's over 50% chance that the U.S. will just unilaterally pull out. And instead of hitting those 5 markets I mentioned, that's going to hit the equities. So everything, these sources of volatility can hit very hard and very unexpectedly. I mean, the timing is what's unexpected.
It's interesting. If you look at across each of the 6 asset classes, there's really only been, I won't even say a mean reversion of volatility in equities. There's been a recent, heightening up from the recent low, which we sat at for a really long time. The rest of the asset classes, for the most part, are still at or near historical lows in volatility. The reason I point that out, Mark, is that Specific to options, options have proven over the last 4 or 5 years of persistently low volatility to have been a great play in low vol environments. It's one of the reasons we looked at short-dated options. Short-dated options, low volatility equals low premium. And what a great, very low cost and effective way to play for discrete risks like GDP, non-farm payrolls, inventories and nat gas and storage and energy. Great, relatively cost-effective tools in low vol environments. Here's the kicker. Despite the fact that we're at low volatility levels and we haven't seen that kind of VIX increase spill over into some of the commodities asset classes, February was an all-time record month for us in Feb, and it actually was not accompanied by an increase in volatility per se. So options have been a great tool for customers to play low vol environments, as well as the significant expansion of use in particularly S&P options in this recent run-up in equity volatility. So it's one of these almost too good to be true products. Great in low volatility environments, even better protection in high vol environments. And customer participation, global use is expanding to such a degree that we're proving that day by day in the expansion of the customer base using our products.
You mentioned the global use. I want to hit on that a little bit as well, because obviously that's an area where a lot of things tend to happen these days. Maybe not so much on the February meltdown, but we've seen a lot of global events. Obviously Brexit, even the election played out primarily in the after hours for the U.S., at least here. So there was a lot of interesting developments. I know that's been a big spearhead for your team, Derek, and a big growth area. What kind of growth are you seeing in the, shall we say, the non-U.S. Use cases and hours for options?
Yeah, I'm a data junkie, and I think it's always helpful to have visuals, so hopefully you can get your listeners some of the charts I can refer to. But kind of taking a couple of steps back, moving away from a month-by-month or even a quarter-by-quarter view, take a step back I'm going to take the listeners back to 2012. Back in 2012, electronic business from non-U.S. customers was the princely sum of 75,000 contracts a day. That was total volume from non-U.S. customers. That represented 9% of our options volumes at the time. Fast forward to 2018, we're doing over 600,000 contracts a day with non-U.S. customers. It's still only 18% of our total options business, and that's below what the overall, we're doing about 30% of our business across the whole franchise, but you can see the significant increase. It's basically a six-fold increase over the course of 6 years. So we see that both that tells us that there is both significant upside growth opportunity here in continuing to onboard European, particularly Asian customers. And what's really exciting, if you think about Asia, you got to talk about China. And China, just I think as your listeners are probably aware, just authorized the launching of options in China in their domestic market 8 months ago. So we're in the very, very early stages of what is a giant trading participant base, just learning about the merits of options. So you got to get to Shanghai and you got to evangelize on the use of options, because it will be a growth market. And we're already seeing that filter through. Even if you go 2016 to 2017, that business doubled from 300,000 contracts a day to 600,000 contracts a day. That's the rate at which we're seeing this business expand. So very excited about the opportunity there, and there's a lot of education and a lot of need to get the word out there as to how to use these products.
We have toyed with that idea for some time. It didn't seem like a few years ago when we investigated that maybe the Asian market was ready to fully embrace options, but I think that story is starting to shift now, and they seem to finally be ready. So maybe there is demand. Maybe in the future of the network there'll be some Asian-oriented content. Blu, is that a big area of study for you and your team as well? Some of the drivers of Asian demand and use case for options going forward over there?
Oh yeah, absolutely, because a lot of things happen in their time zone, and they need liquidity in the middle of our night, and they have it. They connect markets sometimes in a different way. You have a different perspective. They trade a lot of gold in the Asian markets, and so you have a different intersection of markets, and understanding, where the price driver is coming from. It might be in the U.S. one day, but it can be in Asia the next day, is very important to how we do our research.
Derek, I want to go back to hit on one thing you mentioned on the information exchange, which I found kind of interesting. You mentioned that at CME, you guys now think of yourselves as an options exchange. I think that might surprise a lot of our listeners who probably still think of CME maybe in the older mode of, the futures outcry pits, and that was kind of first and foremost. So tell us, when did that change of mindset come about over there at CME, and is that, what have we seen as a result?
Yeah, I think we sat down and looked at the state of the options franchise back in 2013, 2014. looking at, typically we ran our options businesses just sort of individually siloed inside each asset class. So
I remember it well.
right, equity options, you'd speak to one guy, and then fixed income options, you'd speak to a different guy. And we were thinking about our options businesses in different asset classes as individual products, and not actually looking at the infrastructure, the technology, the investment that that we should be thinking about if we're going to truly globalize participation as the single largest multi-asset class derivatives exchange. And so what it did was it forced us to rethink trying to solve 6 problems one way or one problem 6 ways. So we ended up pivoting to what are the consistent problems and growth opportunities that we're facing in scaling our options business, and inevitably, market comes back to technology every single time. And if you look at the investments we made in technology over the last 4 or 5 years, we've got a slide that talks about the significant growth in options spread trading on Globex, which is probably the best marker of the results of the investments in technology we've made to electronify what are effectively high-touch, high-complex option spreads. We put those on the box, either through RFQ technology or direct trading directly on Globex. So it really unleashed a much broader definition of who we are and who we want to be. And I think we're growing into that, because at 6.1 million contracts a day in February, that tells you we are the world's largest option exchange. Hard to compare single stock equities to, say, a euro-dollar contract of $1 million face. Nonetheless, when you look at the broad asset classes we cover and the technology solutions we've provided and the results that we're seeing, it's really allowed us to unlock significantly greater adoption and growth in investment we made in technology.
Yeah, each of you, before we wrap up here, to put on your prognostication hats a little bit. Blue, I know you're always looking ahead for drivers of volatility and things, and also maybe our listeners might be interested to know what product areas and categories are lining up for future research for you and your team. So what are the areas you're focusing on in the next few months?
Well, we've got a lot of research going into the question of transactions costs and liquidity during stressful periods. Liquidity is great, but there are times where you really need it. And when we've looked at different kinds of event risk episodes, from Brexit, the US elections, things like that, what we've seen is that when the outcome of the election or whatever it is comes out, you have what we call the outcome discovery period. It lasts 5 or 6 hours, but the liquidity is there. And transactions costs might be just a little higher than later in the day, but they're really very low. And so the volume actually comes to the market during those periods for these major products that we have. So we're really, doing our study of event risk. We're looking at all kind of probability risk studies. So it's very much, if you will, options driven. That's,
I look forward when you can roll up the studies to include February 5th. That'll be interesting to see how that played out, because we saw different products unfolding in different ways on that day. So I'll be curious. We'll have to bring you back on when you have all that data at hand. Same question for you, Derek. A little bit different though. Obviously, people we like to leave people with a little bit maybe of a hint, of a tease of what they can expect from the CME options team coming. You guys always have interesting new products in the hopper. So anything we could leave them with that will make them want more, Derek?
Yeah, I would say, and Nick Howard is a great participant.
I don't know who you're talking about.
Participant, that guy, is also a tremendous partner in building out the analytics capabilities on our front end as well. So what we've been doing is investing in both CME Direct and the analytics around our markets, and products like the heat map to let customers quickly identify where's the price action happening. And if you can quickly look at the tools we got on the website and say, wow, there's a lot of price action in a 20 delta, WTI puts, that tells you there's a fear gauge right there. Someone's concerned about a rapid decline in what's going on. So there's some coverage going on. Same thing in equities, same thing in fixed income, same thing in energy. So there's the tools that we're building out, we're continuing to scale and expand those, and increase functionality on CME Direct to unlock more of that complex spread trading and price discovery risk transference process. So more of the awesomeness that we deliver, so expect more of that from us from a new product perspective. More fun stuff.
That could be the headline for the show, title of the show. More awesomeness from CME. Speaking of awesomeness, I'd be remiss if I didn't ask you this. We've been, as you might imagine, towards the end of last year, our listeners overwhelmed us with questions about crypto. The last month or so, it kind of dried up a little bit for understandable reasons. Going forward, is there anything we can leave them with a hint? Because I know they're going to ask me, hey, what about options someday in the future at CME? 2018, 2019, can we give them broad strokes, anything along those lines?
Yeah, I would say, listen, for those of us that have been in options markets our whole careers, there's a sort of a hallmark belief that you need to make sure that you build good, credible, continuous markets in your future before you start putting a leverage risk tool like options into markets. So we're focused on what clients are asking us to work on right now, and that it's an early build in those markets, crypto generally. So I think that we're going to stay focused on building liquidity and building good client participation there. And we'll see how that demand evolves over time.
There you go. You heard it here first, listeners. Blu, I want to thank you. Derek, I want to thank you. And we'll have to check back in with you guys soon to see how all these trends are developing in the coming months.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.